How are your projects coming? Close to done, right? There'll be a more comprehensive to-do list tomorrow that lists out everything that needs to get done. So you have a very clear idea of, what's due when, how to, what. So hopefully that will help. Okay, we're at time. I'm going to get started even as people join in. I know people are coming from other classes. You might be running a couple of minutes late. So I'm going to start today by extending something we talked about last session. You remember we talked about valuing an oil company based on its developed reserves and its undeveloped reserves. And very simply put, developed reserves, I said, you can value using a discounted cash flow model. You project the cash flows, you have a risk-adjusted discount rate, you get a present value. The undeveloped reserves, you can start with a discounted cash flow model, but that becomes an input into an option pricing model. Why? Because there's an optionality with undeveloped reserves where you choose to do what those reserves, whatever you choose to, based on observing the price. So today's start of the class test is going to build on that premise. So let's assume you have two companies. And for the moment, kind of hang in there. The two companies are Royal Dutch and Petrobras. Let's assume for purposes just of discussion that they both trade at the same market cap. But here's the difference. Royal Dutch gets most of its value from developed reserves, and Petrobras gets most of its value from undeveloped reserves. So right now they're at the same market cap. So here's the first question. And this is an easy one, so let's get that out of the way. Let's assume there's a crisis in the Middle East. And that's a pretty reasonable assumption. There's always a crisis in the Middle East. The oil price jumps from $60 to $100 a barrel. Both companies are obviously going to benefit. They're both oil companies. Oil prices are now higher. So the market cap is going to go up. So my first question is, which of these two companies, assuming that they both have a $100 billion market cap to begin with, which company do you think will go up more, if any? Which company benefits more from the higher level of prices? Rodrigo, you want to try? Which of the two companies?
I think Petrobras goes up more because more of the options get in the money.
But remember, right now I just changed the level of the oil, right? So both companies benefit from having higher oil prices. It's true Petrobras gets a higher oil price in the options, but Royal Dutch is getting more oil out of the ground right now. So you can sell at the $100 oil price. So it's tough to tell. They both will be benefited. They'll both go up. Maybe Petrobras, Royal Dutch might go up more than Petrobras slightly because they have more oil right now that they can sell. But let's make this interesting. Let's suppose tomorrow the oil price drops back to 60. Crisis has passed. Will both companies drop back to where they were before, or has this incident changed the values of the company? So Rodrigo, I'm going to come back to you. Now use the options argument. You're back to where you were 2 days ago when the market cap was 100 billion for both companies.
Yeah.
What do you think will happen after this?
Since Petrobras is underdeveloped, they don't lose 100% in terms of revenues.
Exactly.
So they have limited loss.
And what will happen to the option? The undeveloped reserve is an option. And what have these 2 days shown me? That the variance in oil prices is much greater than I thought it was. So I'm going to revalue the option, which effectively means even though the oil price hasn't changed, Petrobras could actually come out of this looking better simply because more of the value comes from optionality. What I'm trying to say is if you're looking at natural resource companies, you worry about the level of the price, iron ore prices, coal prices, and that's good to worry about. But also think about the variance in that price because it can affect how much you value the undeveloped reserves by. So today we're going to take the real options argument to the next level. So kind of put on your seatbelts because we're going to do some really interesting things. Remember the last session we talked about the option to delay, and we used that to value patents and undeveloped reserves. Then we talked about the option to expand, which is what used to justify investing in a big emerging market and a big artificial intelligence as a market. Today, I want to talk about the option to abandon. And as I described it very early in this class, I said, it's nice to have the option to walk away from your mistakes, whether you're an individual or a business. And an option to abandon captures the value of being able to walk away from your mistakes. In fact, it's the only real option we're going to talk about, which is a put option. Every other option in the real options component is a call option, patents, undeveloped reserves. But the option to abandon is a put option. Let me explain what makes it a put option. You're in a project, and you suddenly realize it's a long-term project. The project is not coming in the way you thought it would. And if you walked away from the project, you'd make $1 billion. You invested $10 billion to come to the project, but you can walk away now and make $1 billion. You're saying, would I do that? It depends on what you think the present value of the cash flows in this project are going to be over the remaining life. If that present value is dropped below $1 billion, you're going to walk away from the project and take the $1 billion. That's your option to abandon. And of course, if that doesn't stay true, then you're going to continue with the project. The option to abandon basically captures the value of being able to walk away from your mistakes. I know it sounds incredibly abstract, but let me try this on a real company. So I want you to play the role of Lear Aircraft, and I'm going to be Airbus. No, you be Airbus and I'll be Lear Aircraft. I'll take the fun part of this transaction. You've heard of Lear Aircraft, right? They make these jets that executives use, and companies have these tiny corporate jets. They're a very good manufacturer, but they don't produce commuter aircraft. But as the CEO of Lear Aircraft, I'm interested in producing a commuter aircraft. I don't know enough about the business, so I come to you, your Airbus, with a proposal for a joint venture. And in this joint venture, I'm going to put in $500 million, you're going to put in $500 million. We're jointly going to produce smaller aircraft, 30 to 40 passengers, so we can compete with the Bombardiers and the Embraers of the world. So I present you with the numbers, and your finance department goes to work. They project out the cash flows in the joint venture, and they come up with the present value of $480 million, which is less than the $500 million I've asked you to invest. So you come back to me and say, sorry, we're not interested. That's a minus $20 million net present value. We can't do the deal. But I really, really want you as a joint venture partner. So I come back to you with a counter proposal. I said, look, if you invest in this project and things don't work out, it's not selling, this is not working out, anytime over the next 5 years, you can walk away from this joint venture and I will pay you $400 million for your 50%. Now, $400 million is less than the $500 million invested, but by offering you this alternative, what have I done? I've kind of put a floor on your losses, right? You invest $500 million, you can walk away and get $400 million. The most you can lose in this project is $100 million. Now, you obviously wouldn't walk away today because today the present value of the cash flows is $480 million. Walking away and getting $400 million doesn't make sense. But if something catastrophic happens next year, you could come to me and say, buy me my 50%. What have I given you? I've given you the option to abandon this project. Now, let's say this project, based on the cash flows, I do a simulation and say that $480 million you have as present value, the standard deviation in that number is, let's assume, 40%. 40% squared is 0.16. So there's uncertainty about the $480 million, which means tomorrow it could become $300 million or it could become $600 million. The project itself is a 30-year project, but you have the option only for the first 5 years to abandon it. Let's see what this option to abandon is worth, viewed as a put option. So let's go through the numbers. The S, the value of the underlying asset, is the present value of the cash flows, $480 million. The strike price is what you will receive on abandonment, which is $400 million. Right now, remember, this is a put. It's an out-of-the-money option. You have 5 years to play the game. During those 5 years, the $480 million is uncertainty captured by that 0.16 variance. And every year that you wait, because it's a finite life project, 30-year project, you have fewer cash flows, you're going to give up some cash flows. Let's say it's 1/30th. I have S, K, R, T, sigma. I have everything I need for a Black-Scholes model. I plug it in. The value that I get for this put is $73 million. I say, what does that tell me? As Airbus, I've given you a put option worth $73 million. Remember, your original net present value was minus $20 million. You stop. Now that I've given you this option, there are no guarantees that you'll join in. You effectively have a net present value of plus $53 million, minus 20 plus the value of the option. Now, as lawyer, I've got to be careful because this is an option I'm giving you. I presumably am getting enough value from this project that I can cover the cost of the option, but that is the benefit of being able to walk away from a project. Now, one of the things I always want to say about real options is getting the numbers is so difficult that many people might never even use an option pricing model to value an option to abandon, but you don't have to use a model, right? It gives you insight about the value of flexibility in investment analysis. And what the option to abandon gives you in general is an understanding of why it's so important to build escape hatches when you take projects. You know, when we escape hatches, you go into a 30-year big infrastructure project, you better give yourself ways of getting out if things don't go well. I mean, a lot of companies view building escape hatches as a sign of weakness. I consider it a sign of strength. This to me is a way of thinking about having the flexibility of being able to walk away, having fewer long-term contracts, building in more cost flexibility. They're all manifestations of having options in your decision-making process. So when you think about, in evaluations, this might just play a back role, but some companies are much more flexible than other companies. They're able to adapt quicker. And those companies should be worth more than companies that don't have that same adaptive power. Nick?
Professor, what's the intuition behind like the dividend in this case, the proxy for dividend we use? Like the more you wait in this case, right? What happens?
Basically what happens, and that's why I stop after 5 years, right? Because in a sense, I can't give you the option to abandon for the next 30 years. Because you know what you'll do? Be my partner for the next 29 years, 364 days, collect all the nice dividends, show up on the very last day of the very last day. Oh my God, I don't like this project. Give me 400 million. So that's the first reason I stopped the option to abandon in 5 years, even though the project goes 30 years. But during those 5 years, because it's a finite life project, the project has fewer years of cash flows left. So if things go badly, I'm more likely to abandon in year 3 rather than in year 1, because I'm looking at the clock saying, you know what, there are only 27 years of cash flows left and I can collect 400 million. So it actually, that's the factor that's playing in here, affecting when I exercise. Sriram?
If you're the firm pricing these like real options, or like if you're the firm that's like granting them, I guess, would you have to consider potentially like switching costs if, for example, like a construction company decides to like stop building a bridge halfway through and now you need someone else to like take on the project?
Yeah, absolutely. That's why I said, if I'm the one giving away this option, I better have all kinds of backups, because otherwise 3 years in, Airbus walks away, I'm still stuck with this project. I still have consequences. So it's very, and this is why you don't want people going around promising other people all kinds of neat stuff. Salesmen, for instance, often when they make a sale, say, well, if you don't like it, you can return it in 2 years. It's easy for the salesman to do. He collects his commission. But if you go around granting people this right to return things and do things, you're giving away valuable stuff. That's what the option to abandon is basically you're giving your customers and your partners ways of walking away, but you're the one bearing the cost. So this better be a really lucrative project for you so you can cover those costs. So now let's talk about kind of a side issue, something we don't talk about often in the context of capital structure, or in the context of option, which is how options play out in the capital structure decision. The capital structure decision in corporate finance is about how much you borrow and how you borrow. The most common manifestations of option pricing in capital structure is when you issue convertible bonds. Convertible preferred. Why? Because there's an actual option there, right? A convertible bond is just a straight bond plus an equity option. I'm not going to talk about those. That's what a fixed income class is for. I'm going to talk about another aspect of capital structure where I think option pricing can give us some really interesting insight. And that is the question of what an optimal debt ratio for a company is. In my corporate finance class, which I haven't taught the undergrads in a long time, I think the last time I taught it was 2007, we talk about the optimal debt ratio for a company. It's actually not difficult. It's a point at which your cost of capital is minimized. And when I've done this for companies, one of the issues I've always run into, especially with companies that are under-levered, that have too little debt, is I'll go to the CFO of the company and say, look, you have only 10% debt. Your optimal debt ratio is 40%. Why don't you borrow more money? One of the most common defenses I hear from CFOs is I don't want to borrow the money because I value financial flexibility. Now, that sounds so good. You're saying, who would argue against financial flexibility? I remember the first 3 or 4 times I ran into this financial flexibility term. It stopped me because what can you say beyond that? Of course you value, everybody values flexibility. The 5th time somebody brought up financial flexibility, I had the courage to say, flexibility to do what? And he said, well, in case a great project comes along, having this excess debt capacity is going to allow me to do that great project or the acquisition. I said, okay, I understand. You're making an options argument. You're saying, I'm holding back on going to the optimal because having that excess debt capacity will allow me to take this incredible project. And I actually tried to value financial flexibility as an option. And I had to go through all sorts of contortions. So if you don't like the shortcuts I took, just ignore them and go to the intuition that comes out of it. This was about 20 years ago. I had, I sat down and said, I'm going to value financial flexibility as an option. And to value it as an option, I need to have a payoff diagram. So what's the underlying asset? What's the strike price? So basically I said, okay, I've got to nail down what the option is coming from. So here's how I structured the option. Think of how much a company reinvests, right? CapEx, working capital every year. There's a certain amount of reinvestment you can cover with your normal access to capital. So let's say that you can raise $100 million of capital because you have a revolving credit line, you go to the bank, $100 million is your expected reinvestment need every year. So you have no trouble. As long as it's $100 million, you can come up with that $100 million. You have no need for debt capacity or any additional ways you can cover it. The essence of an option is that you get a project that requires $1 billion. It's a great project, a project you've never seen before, but you can't cover it with normal access to capital. So what do? You take that excess debt capacity that you've nursed for so long and you use it to take this great project. That is where the option comes from, is if that great project comes along, you take that project with your excess debt capacity. That's the upside of maintaining debt capacity. They say, what's the cost of doing this? The cost of doing this, you stay undercapitalized, right? Your cost of capital is higher than it has to be, but you accept it because you get the financial flexibility in return. So I said, okay, if I can value financial flexibility, then I can then compare what I'm getting to what I'm giving up and see if this makes sense for you as a company. What I'm trying to do is come up with a way where for some companies, I say, okay. For other companies, and no, it doesn't work for you. A way of differentiating across companies where I can say for these companies, financial flexibility is worth enough that they should be under-levered, but for these companies, it doesn't make sense. Sorry, hang on just a moment. My Siri started speaking up. I don't know why. She just pipes up. Jacob, your question?
Yeah, I was just wondering, in the context of like a valuation model, the benefit here comes up mostly in like a lower default probability or like bankruptcy probability, or is there another benefit?
In a discounted cash flow model, you really can't build optionality, right? You show it as a lower probability, but ultimately, if you're under-levered, what you lose by being under-levered will exceed what you gain. So in this firm, for instance, even if you allow for a higher default probability and put in a higher cost of debt, your cost of capital will be low enough that your overall value will go up by moving to the optimal. That's what the entire, so here you're actually giving up value today in return for what? In return for this option to do stuff in the future that you otherwise wouldn't have. So maybe the only place it would show up is by having this excess debt capacity, you get more lucrative growth in the future. Higher growth, higher return growth, because the debt capacity allows you to do it. But it's actually very difficult to build into DCF. And that's why we bring the real options terminology into the discussion. So I'm going to take you back to 1997. It was one of the first editions of my Applied Corporate Finance book. The company I used then, and I still continue to use, was Disney. And I did an optimal debt ratio for Disney. And it's a very, as I said, a very straightforward process. Their existing debt ratio was 18%, at which point their cost of capital was 12.22%. And based on looking at the cost of capital, it looked like their optimal debt ratio is 40%, but the cost of capital is 11.64%. So if I were making a sales pitch to Disney and moving to the optimal, my sales pitch would be, right now your cost of capital is 12.22%, but if you move to the optimal, your cost of capital will be 11.64%. What do you gain? You gain a cost of capital that's 58 basis points lower on an annual basis. Now let's say the Disney CFO says, I know, but I'm not going to do it because we value financial flexibility at Disney. You know what my challenge is, right? To value financial flexibility and see if I get a benefit greater than 58 basis points on an annual basis. If I do, the CFO has a point. I shouldn't push him to increase debt. But if he doesn't, I'm going to keep pushing. So I decided to try to value financial flexibility. And here's where the contortions came in, because it doesn't fit easily into traditional option pricing models. I decided to value it on a single year basis. So T is 1. On an annual basis, how much is financial flexibility worth at Disney? But for the inputs, here's what I use. For the reinvestment needs that Disney has every year, I looked at what their net capex and change in working capital and acquisitions were as a percentage of value over the previous 5 years. And over the 5 years leading into 1997, Disney's reinvestment as a percentage of their enterprise value is about 5.3%. So I take it every year. But that number jumped around. They did an acquisition of Cap Cities ABC in 1 year. So the standard deviation in this number was 0.375. So I have how much you reinvest and how uncertain I'm about the reinvestment. In a typical year, Disney was raising about 4.8% of its value from traditional financing. It's revolving credit, it's debt, it's traditional equity, it's retained earnings, 4.8%. And as I said, I'm going to value this for a 1 year option. Let me tell you what the end game here is. If I value this option and come up with the value greater than 0.58%, the value of flexibility is greater than what they give up by being underlevered, and they should stay underlevered. If the value of flexibility is less than 0.58%, then I don't care how much you value flexibility, you should go to your optimal debt ratio. So to value flexibility, I put in that SKT, I put in an option pricing model, and what it gave me was about 1.61%, 1.6092%. That's just plugging numbers in. So that's the value of an option to take a project that you're getting because of excess debt capacity. But remember, a project has value only if you earn more than your cost of capital. And in 1997, Disney was earning a return on capital of 18.69%, well above its cost of capital, 6.47% higher. If I make the assumption, it's an assumption, that that's what they will make on this new project that they will take, it turns out that the value of financial flexibility is about 0.85% every year. By staying under levered, they're getting financial flexibility, and that financial flexibility is delivering about 85 basis points every year. That's higher than the 58 basis points they're giving up by being underlevered. And guess what? If I believe these numbers, I'm going to tell Disney, you're right. You shouldn't borrow the extra money. Stay at an 18% debt ratio. I have some advice for you. Don't try to do this full-fledged calculation. You're going to go crazy. It took me 2 days to actually come up with the numbers and doing this. And why did you waste your time? Because the implications of what we've done here go beyond actual calculations. And let me lay out what I see coming out of that option pricing view of flexibility. And you tell me whether you buy into it. Why are you preserving excess? Why am I preserving excess debt capacity? What's the sales pitch I'm making as a CFO when I preserve excess debt capacity?
Because if a project comes along, you can take on debt and then
and implicit there, what am I telling you about my access to external capital?
That the markets are receptive.
Or I can't raise capital, right? Because I'm saying there's a capital constraint. So let me make my first statement. The greater your access to external capital markets, the easier your access to capital, the less value you should attach to financial flexibility. Do you see why? If you have supreme access to capital markets, you don't need to maintain excess debt capacity. A great project comes along, you just go out and raise equity, raise debt. So the more access you have to capital markets, the less you should value financial flexibility, which means you should be more likely to be closer to your optimal debt ratio. So let me draw some distinctions and you tell me whether you agree with these. Small companies should value financial flexibility more than larger companies. Why? Larger companies have more access to capital, smaller companies don't. I would expect smaller companies, therefore, to be more underlevered than larger companies. Private companies should value financial flexibility a lot more than public companies. You see why? Public companies have access to capital markets, stock markets, bond markets. Private companies, they have to use internal equity, which is tough to come up with, and borrow from a bank, which might be restricted. Private companies are therefore more likely to be under-levered than public companies. Emerging market companies should value financial flexibility a great deal more than developed market companies. Why? Emerging markets capital can shut down on a, if you're an Argentine company, you better not borrow money because you need that excess debt capacity just to make it through the next crisis. Already you can start to see how a very simple option view of the world would lead you to be more forgiving of an emerging market company being under-levered. I'm not going to ask a Brazilian company that has a debt ratio of 10% to move to its optimal of 40%, because I think in Brazil it's good to stay at 10% given that your access to capital could potentially dry up. Here's my second stop. If you think about what drives the value of the option, it's not just how much you reinvest, but how uncertain you are about that reinvestment, right? So for instance, if you're an infrastructure company and you have a lot of money to reinvest, but you know exactly what that reinvestment will be for the next 20 years, you don't need to maintain excess debt capacity because you know what your needs are. You can go out and borrow exactly what you need. But conversely, if you're a technology company where it's not just how much you reinvest, but that number could shift around dramatically based on what's going on, you're going to value financial flexibility a lot more. I understand why technology companies are among the most under-levered companies in the market. Could Google borrow more money? Absolutely. They have a debt ratio close to 0%. It's 1.5%. Their optimal debt ratio is 20%. Am I going to push them to 20%? Not in this universe, because they're in a business where everything could change overnight. Think of how quickly Yahoo went from hero to zero, right? 2003, Yahoo rules the world. 2005, it's gone. The more uncertain you feel about future reinvestment needs, the more you will value flexibility. And finally, the value of flexibility comes from not just taking projects, but the projects have to earn excess returns. At 6.47% that I assumed was what gave me the value of the project. In fact, if I go back to the previous page and assume that Disney earns its cost of capital, you know what's going to happen to the value of flexibility? The 0.64% becomes 0%, and the value of my flexibility as an option goes to zero. And that shouldn't be surprising. If you're in a bad business and you have a tough time earning your cost of capital, don't even talk to me about maintaining excess debt capacity, because what the heck are you going to use that debt capacity to do? Your projects are all neutral or negative net present value projects. Companies in good businesses where you can earn well above the cost of capital should value financial flexibility a great deal more than companies that are not in good businesses. So if you're Kohl's, brick and mortar retail company, and you're under-levered, and I push you to borrow money and you say, no, I need financial flexibility, I'm not going to accept it. You're a brick and mortar retail company. What kind of projects are going to come about that earn more than the cost of capital? So even though you might never use this equation to value an option, keep it in your back pocket because it's going to give you some insight and some degree of understanding of why some companies may choose not to borrow money, even though you work with the cost of capital. So your cost of capital could be so much lower if you use more debt. Because what you might give up in terms of financial flexibility wipes out those benefits. Which brings me to my final application of real options. And this is a really fun application. When I start, you're going to say there's nothing fun about this, but as I described, you're going to see why this is one of the most interesting applications of options. Let's say you go out and buy shares in a publicly traded company. You're an equity investor in a publicly traded company. Think of the nature of your claim. First, it's a residual claim. You know what I mean by residual claim? As an equity investor in a publicly traded company, you get whatever's left over after everybody else has been paid. That's true in operations. It's also true in liquidation, right? When I liquidate a company, the first claim goes to the bankers, then the preferred. I mean, basically, you're the last person in line. It's a residual claim. Second, equity investors in publicly traded companies have limited liability. What does that mean, Jake? When I say limited liability, you're a shareholder in a publicly traded company. What does that mean to you?
I'm not really sure.
What's the lowest a stock price can go?
of 0.
Yeah.
Oh, so you
So let's-
can't be liable for more
Exactly.
than.
In other words, a broker can't call you and say, send me $15 more, the company's in deep trouble, right? Where as opposed to being the owner of a private business, we might not have limited liability, because if your business goes bankrupt, they can go after your personal assets. Thank God for that. You got limited liability. Those two features make equity in publicly traded companies behave like an option. So let me stay true to what I've been doing all the way through. Whenever I have an option, what do? I draw the payoff diagram. So let's draw the payoff diagram for equity as an option in a publicly traded company. You guys be the equity investors, I'll be the bank. I'll take the less fun role here. You borrow money from me, you get to run the company. As the equity investors in a publicly traded company, you can choose to liquidate the company anytime you want. That's your right. And if you do, let's see what happens. If the value of the assets of the firm, first thing I'm going to do as a lender is I'm going to collect, so you got to pay me off. And if there's anything left over, because it's a residual cash flow, you get to keep the difference. So if you have $100 million in debt and you liquidate the company for $150 million, you get to keep the $50 million. If you liquidate for $120 million, you get to keep the $20 million. If you liquidate for $60 million, tell me what happens. Angela, I owe $100 million. I'm the equity investor in a publicly traded firm. I've liquidated the firm and got $60 million. What do I do? Who gets the $60 million?
Sorry, Professor, can you repeat that again, please?
Okay. So you're the equity investor. You're running a publicly traded company, right? You decide to liquidate the company. You owe $100 million to your bankers, but in your liquidation, you get only $60 million. What happens?
So do I have to pay the 60 to the bank then?
Okay. And how come you don't have to pay the remaining 40?
Because I have limited liability.
Exactly. So the most you can lose in equity is what you originally paid. So if the value of the firm is less than the face value of the debt, the most you can lose is what you originally paid. They can't come after your assets. Hey, that looks like a call option, doesn't it? In fact, let's try a very simplistic example. And I'm going to milk this example for every ounce that I can get out of it to bring in some very interesting conflicts in companies. So you continue to play the role of an equity investor. I'm going to be a lender. You're an equity investor and I'm a lender to a firm that right now we value the entire firm at $100 million. Saying, how do you value the firm? I'm going to use the DCF value, or liquid, whatever it is. The value of the firm right now is $100 million. And I'll tell you what my debt looks like. I've lent you money on a 10-year zero coupon bond with an $80 million face value. So Morris, what does that mean? For when you take $80 million zero coupon bond with a 10-year maturity, what are your obligations as the equity investor running the company? What do you have to pay?
Sorry, can you repeat the question? You're breaking up.
So I've lent you money. It's a 10-year zero coupon bond with an $80 million face value. What are your cash flow obligations to the company? How much do you have to pay next year? It's zero coupon, so nothing, right? Year 2, nothing. Year 3, nothing. But the end of year 10, you got to pay me $80 million. So that's my debt. You're going to see in a minute why I created the zero coupon bond. It's going to make my life simpler. Now, of course, the $100 million that I gave you as value could move around because things change. It's a macroeconomic factors. Interest rate change. Jerome Powell says crazy things. My value changes again. Let's say the standard deviation in the value is 40%. So the 100 million could become much higher, much lower. And the riskless rate is 10%. So basically, I've given you the value of the firm, the debt here, 10-year zero coupon bond, a standard deviation, and a T-bond rate. With that minimalist information, I'm going to argue you'd be able to tell me how much the equity that you bought is worth and what a fair market interest rate I should charge on the debt is. You're saying, how am I going to do that? You haven't given me a beta, cash flows. There's enough information on this page for you to be able to value the equity in the company and tell me what the fair market interest rate on the debt is. And here's how we're going to do it. We're going to value it as an option. You are the holder of the option as the equity investor. Here's what your option looks like. The value of the firm right now, that 100 million becomes the S in the model. The exercise price becomes what you have to pay if you liquidate the firm. If you liquidate the firm, you got to pay me 80 million. That becomes the K in the model. For the next 9 years and 364 days, you rule the company as the equity investor. I can't stop you. Now do you see why I made it a nice zero coupon bond? Because in a traditional coupon bond, what do you have? Every year you got to make a coupon payment. The power shifts to me. In this case, I've given you complete power for the next 10 years. At the end of the 10th year, the power comes to me because you owe me money. And of course, over the 10 years, what can happen? The value can go up, the value can go down by how much? The variance in the value is 0.4 squared, which is 0.16, 40% squared. The riskless rate is 10%. Ready? SKRT sigma. I've got everything I need for an option pricing model. I do D1, D2, N of D1, and N of D2. I'll get to the bottom line. If I plug the numbers in, the value that I get for a call option is 75.94 million. You say, what the heck is that? Remember, you as an equity investor own the call option. Your equity is worth 75.94 million. But since the value of the firm is 100 million, the difference is the value of my debt, 24.06 million, 100 minus the value of the equity. It's a zero coupon bond. If the value of the bond now is 24.06 and you pay me 80 million in 10 years, and I solve for the interest rate, that's the 1/10 is basically the compounded rate. The interest rate on the debt is 12.77%. It's magic. I value the equity. I've given you a fair interest rate on the debt. And there's one more bonus piece of information I can give you. Remember when I did the Black-Scholes model, I pointed to ND2, and I said it's a risk-neutral probability that S will be greater than K. Risk neutral. So Parth, help me out here. Take a look at that output that you have. N of D2 is 63.1%. What is this model telling you about the future?
I suppose it's predicting that there's a 63% chance that the value of your company or your option will rise.
Value of the firm will be greater than the outstanding debt, right? There's a 63%. So if there's a 63% chance the value of my firm is greater than the outstanding debt, there's a 37% chance that that's not going to happen. You say, who cares? What happens if the value of your firm is less than what you owe? You're technically bankrupt. There's a 37% chance of bankruptcy, and it's embedded in the model. So at the end of this model, I'm giving you the value of equity, 75.94. I'm giving you a fair market interest rate on the debt, 12.77%. And I'm saying there's a 37% chance of bankruptcy. That's pretty rich from the minimalist information. Nick, you have a question?
Yeah. For example, if you have a non-zero coupon bond, could you then use the model with the dividend?
No, what you'd have then is 10 options piled on top of each other. You can still do it, but what you have is you have a series of 1-year options, which is doable, but it gets incredibly messy. Right? So the option argument still applies, but it'll be a series of 10-year options, each of which is conditional on the previous options surviving. So rather than a binomial model, you're going to have to value 10 different options piled up on top of each other.
I see. That makes sense.
Okay. So let's say that you believe me. Bad mistake, but you take your money and you buy the equity in the company and you pay 75.94 million. Because I've told you it's a fair price. And tomorrow you wake up to some really bad news. Half the company has disappeared. Don't ask me how that happens. But let's say this company has 2 factories, one in California, one in Florida. You take your pick, earthquake or hurricane, one of those factories has disappeared. This is not good news, right? Your $100 million value has now become 50 million. So I'm going to start with a very simple question. Sriram, maybe you can help me out. My value before this happened was 75.94 million for the equity. That's the value you pay. Now, half the company has disappeared, and that half is worth 50 million. The value of the company has dropped by 50 million. My question is a very pragmatic one. How much will the equity be worth after this catastrophe? Will it drop by exactly 50 million, which is the loss in value? By more than 50 million, because the accountant says you're a book value disaster, or less than 50 million? What do you think?
I'm guessing less than 50 million because typically options are concave. up?
In fact, so in fact, it is less than 50 million. But if it drops by less than 50 million, somebody else is bearing the pain, right? The 50 million loss is the real one. So if you lose only 45 million as the equity investors, who's the only other player in this game? Who else is there to lose? It's a lender, right? That lender is not going to sit there saying nothing happened to me. This company has now become more risky. There's a greater chance of bankruptcy. The lender is going to find that 24 million that he paid before is also going to drop. So let's play it out. Let's see what happens. So I'm going to try to value the equity in the firm with half the firm gone. The only thing that changes in my option pricing model is my SB, instead of being 100 million, is now 50 million. Everything else stays exactly the same strike price, because I still owe the same $80 million face value bond, same 10 years to maturity, same standard deviation, because even though the company has become smaller, the standard deviation is a percentage change in the value that hasn't changed. Let's see what happens to value of the equity. And again, reminder, the value of equity was worth 75.94 before. It now drops to 30.44 million. So you lost $45.5 million. So Sriram's instincts were right. The value of the equity drops by $45.5 million. But the value of the debt drops by $4.5 million. Why? Because the lender now looks at this firm and says, this is a riskier firm. There's a greater chance of bankruptcy. And Alex, what's the chance of bankruptcy after this happens? It used to be 37% before the disaster. Can you take a look at this page and see if there's a number that can help you estimate the probability of bankruptcy after you lose half the firm? Take a look at ND2. ND2, we said, tells you it used to be 50, when we did it earlier, it used to be 63%. Now it's dropped to 42% or 41.6%. So after I've lost half the firm, the chance that I can meet my debt payments has dropped from 63% down to 42%. The chance of bankruptcy went up to 58%. It's no surprise that the lenders don't like this happening either. Equity investors lose out, lenders lose out, the probability of bankruptcy goes up. And once I did this, I couldn't stop myself. Let me explain. I dropped the value from 100 to 50, the equity hung in there. Then I dropped the value of the firm to 40, to 30, to 20, to 10, to 5. You know what I was trying to find out? When does equity in a publicly traded firm become worthless? Because you still owe that $80 million on that zero coupon bond. And you know what the answer I got was? Equity is an incredibly stubborn instrument. It did not want to go away. I dropped the value of the firm to 5 million, to 3 million, to 2 million, and the equity just hung in there. So Rodrigo, help me out here. What's keeping the equity afloat? I'm making this company a basket case company, right? Because at 5 million, I still owe 80 million. Every accountant is going to say, you're crazy. This company is a bankrupt company. But the equity still trades. So what is keeping equity afloat in this company as the value of the firm is low?
It's the high standard deviation with a small probability of some payout.
And time. Don't forget it,
Time.
because you have 10 years to play the game and you're saying maybe something good will happen and you pray that something good will happen. It's hope and time. This actually will explain something you might see in markets. You'll see a company that everybody describes as a basket case company. It's a money-losing company with a lot of debt, but the equity keeps trading. You're saying, are these people crazy? They might be, but they might not be. They might be buying the equity for the same reasons you buy D part of the money options. When you buy D part of the money options, 95 times out of 100, what happens to that option? It ends up worthless. But when it does pay off, it pays off big time. That's basically what happens to equity in deeply distressed companies that are money losing. It starts to behave like an option. In fact, now when I did this, I got an entirely new perspective on what bankruptcy actually means. Actually, let me take that away. I actually got this perspective from my daughter when she was 3. She's a genius. Actually not, but she gave these insights that became genius in hindsight. So the summer when she was 3 years old, I would play with the 2 older brothers. We'd play Monopoly. And my 3-year-old daughter would insist on joining in. And she's very persistent. So finally we let her in. She says, Kendra, okay, you can play the game. And after about 2 times that she played the game, I had to banish her because she was like a one-person Enron. She would collect $200 without passing go, put up hotels and properties that didn't belong to her, try to charge you rents on things you didn't even have houses on. So after about 3 or 4 of these incidents, I said, Kendra, you're banned. She gets up, tiny person, horrible temper. She starts walking around. She says, you're bankrupt, you're bankrupt. I'm very impressed that 3-year-old is using the word bankrupt. So I said, what does bankrupt mean? Expecting an answer like the value of your assets is going to be greater than the value of your outstanding liabilities. She says, bankrupt means you don't get to play the game anymore. You know what? That's a perfect definition of bankruptcy. As long as you get to play the game as an equity investor, you are not bankrupt. And for the next 9 years and 364 days, guess what? You're going to play the game. The closer you get to that end game, the closer your equity is going to be worth nothing. So if there's 2 days left, obviously the equity is going to be worth nothing. It still looks like this. But that's at the core of why equity can become like an option in deeply distressed money-losing companies. Now, I'm actually going to use that very abstract example to kind of shake your belief in things you've been taught in corporate finance and in M&A. Let's say you're the equity investor in this company. Let me take you back pre-catastrophe when the equity was worth $75.94 million. The value of the firm was 100. The value of the debt was 24.06 million. Let's suppose I come to you with a project. I'm trying to sell this project to you. And as I describe this project, you get less and less interest. And here's why. The net present value of this project is minus 2 million. What are we taught in corporate finance about negative net present value projects? Don't take them, right? So you get ready to throw me out of your office. I said, wait. Not only is this a bad project, it's a very risky project. Now this is going from bad to worse, right? It's a negative net present value project that's really risky. In fact, taking this project will increase your standard deviation as a company from 40 to 50%. Now, every fiber of your corporate finance being says, don't take this project. But I'm going to show you some magic that's going to happen here. To you as an equity investor, you're going to make one of the worst decisions in your life, and you're going to come out as a winner. And let's see why. Let's assume you go out and take this project. Think of what it's going to do. You take a negative net present value project, your $100 million value is going to drop to 98 because that's what NPV does. It's additive. So your firm became less valuable. And it also became more risky. The standard deviation went from 40 to 50%. Nothing so far looks good, right? Your firm's become less valuable. It's become more risky. Remember your equity was worth $75.94 million before you made this horrendous decision. Let's see how you've been punished. You make this horrendous decision, guess what happens to the value of your equity? It goes from $75.94 million to $77.71. If this is punishment, punish me more. You took a bad decision, your equity value went up. You're saying, how can that be? You know who's bearing the loss here? Who's the big loser after this transaction? Equity investors come out as winners. The firm becomes less valuable. But the lenders who are worth 24.06 million drop to 20.29 million. This is a classic problem in business. It's called the risk sharing problem. Basically, it reflects the fact that equity investors in a company, once they take lenders' money, are going to be tempted to take riskier and riskier and riskier projects because they get the upside and lenders get the downside. You know what the lesson from this is? If you're a bank and you're lending money on a leverage buyout, you cannot be a passive lender. You know what I mean by a passive lender? You can't just lend the money and say, I'll collect my interest expenses. You have to be actively involved in how the company is run, because if you're not, you're going to get taken to the cleaners. Sriram.
Is this why like a corporate action, like a spin-off might potentially increase the value, like the overall value, because it localizes risk?
Especially when you have a lot of debt, all kinds of effects come out. In fact, the next one I'm going to do is an acquisition, and you're going to see the same phenomenon play out. In both spin-offs and acquisitions, you can alter not just the level of the value, but the standard deviation of the value. So if I spun off the safest parts of my company, guess what I've done to the equity as an option? I've made it more valuable because the remaining company is now much riskier. So every action that a company takes, and we're so trained to think of level effects, right? Net present value. We don't think about the standard deviation effects. And what real options remind you is it's not just the level, but the uncertainty about the level that'll affect the relative valuations of debt and equity. And actually, I'm glad you brought up spin-offs, because I'm going to do an acquisition. And again, I'm going to take something we're taught in M&A classes, which is if you pay fair value for an acquisition, we're told it's value neutral. In other words, you take a company valued 100 million, you pay 150 million. No, I'm sorry, 100. So you valued at 150 million, you pay 150 million. Doing that transaction should not affect your value. And that's actually good advice, but here's what you might be missing. Let's assume that you are back to being the shareholders in the firm that I just described. And you're looking at a second firm with a value of 150 million. They both have debt. So each of these firms are standalone firms now. The lenders to these firms have lent money based on the riskiness of these two firms. Let's say everybody's on, right now everything is fair. What are you planning to do? You're planning to combine these two firms. Now, for purposes to make this interesting, let's assume these two firms are in different businesses. One is a chemical firm and the other is a technology company. How does this play out? The correlation in cash flows between these firms is 0.4, which means a lot of the time they don't move together. That's what happens in conglomerate mergers, right? You buy a company in a different business. You think, so what? Remember early in finance and in foundations, you did this 2-asset portfolio to illustrate the effect of diversification. You took asset A and asset B, variances both. And I've asked you, what will happen when you combine the two? Here's how you estimate the variance of the combined portfolio. You take the weight on the first asset squared times the variance of the first asset, weight on the second asset times the variance of the second asset. And then you bring in a covariance term to capture how the two assets move together. There's the magic of diversification. Is in this case, combining these two firms gives you a variance of 0.154, which is lower than the variance of the two firms that went into the transaction. It looks like magic, but it almost always happens in a conglomerate merger. The combined firm is going to be safer than the two individual firms because they offset each other, at least some of the time. You think, so what? Let's say you do this merger. You know who's going to be the big winner in this merger? These bankers who lent money to the firm, to the old firms, based on their standalone risk, if you allow them to continue as lenders after the transaction, are going to be lending to a much safer firm and charging the same interest rate. And if you do nothing, here's what the effect will be. The value of your equity will actually decrease after this fair value acquisition, because the bankers will find that their debt value goes up because they're now lending to a safer firm. Conglomerate mergers create leakage on equity value because of this wealth transfer. It happens in every conglomerate. And if you're a sensible conglomerate, the way you push back is either by renegotiating interest rates after the deal gets done. You go to the bankers and say, look, guys, you were charging 8% before, but we're now a safer firm, you should charge 6.5%. And if they refuse to do it, you have another weapon. Just use more debt on the deal. By using more debt, you can transfer the wealth back. So anytime you have a spin-off, a divestiture, an acquisition, think about the consequences for the risk of the remaining firm or the firm after the deal, because that's what's going to drive the equity value. Jay?
How does the decrease in equity value show up in a DCF? Like, what changes to decrease the value?
It doesn't. That's the problem. In a DCF, you're going to miss it. And that's my point, is unless you bring in the option perspective, in a DCF, you're going to completely miss it. You say it's a fair value deal, nothing happens, when in fact this might be happening under the surface. Okay. So let's think about applying this on a real company. The example that I gave you was incredibly abstract, right? I gave you the value of the firm, I gave you the variance, I made it a nice zero coupon bond. What company do you ever run into that has one nice zero coupon bond as its only debt? See, how do I apply this on a real company? First, think about the types of companies we want to apply this. It's got to be companies that have a lot of debt. If you have 5% debt, 10% debt, don't even think about using this. And it's got to be some kind of a distressed company, a money-losing company. So think about the company you valued for your project. If it's a money-losing company with a lot of debt, there might be an option perspective on the equity that might give you a different value. I'll also tell you, based on my experience, maybe 1 in 10 companies will fit this. So if you look at your group and none of your companies fit these, don't panic. It can happen. But if you do have a company that's money losing and a lot of debt, perhaps you can apply an option pricing model. But to apply an option pricing model, I need all those inputs I gave you in the abstract example, right? First, I need a value for the firm. Where am I going to get that? Hey, if you've done your DCF on your firm already, so let's say that the firm you're valuing is Jet Airways, it's an Indian airline. You do a DCF value and you came up with 50 million. That becomes the S in the model. That's what you think. If you don't want to do a DCF, you can apply a multiple, EV to sales on revenues, come up with the pricing. If even that is too much, you could do a liquidation value. Basically, the S in the model will be what you get today if you sold off the firm or sold it off in pieces. That becomes the S. The problem with getting a variance in this model is you want a variance in firm value. It'll give you 3 ways, and each is less work than the previous one. The most difficult, the most time intensive is to do a Monte Carlo simulation. In other words, when you do a DCF, in addition to getting one value, if you put in distributions, you can get a distribution of value. The standard deviation of that distribution can become the standard deviation of the option. If you don't want to do that, and the stocks and bonds in this company are both traded, you can use the standard deviations of the shares and the bonds separately to come up with the variance in firm value. But let's say you're even too lazy to do that. Remember how we got betas for companies? If a steel company, say, go look up the beta for a steel company. What if I could give you a table where I could give you the variances in firm value for companies in different sectors? Actually, I have one on my website. If you go to my data, I have variances in firm value for different businesses. You have a troubled steel company with a lot of debt. You can go look up the standard deviation firm values of steel companies. So that's going to give me a sigma. That 40% that I assumed for the hypothetical company, I can give you an equivalent number for your company. So I've got S, I've got sigma. I have to deal with the fact that no troubled company I've ever valued comes with one nice zero coupon bond. They have 50 different bonds. They borrow from everybody who lend them money. So you know what I'm going to do? I'm going to cheat. I'm going to take all of the debt that this company has, consolidate it, and convert it into an equivalent zero coupon bond. In other words, I'm going to take your 15 bond issue and say, that's like having a 7-year bond with a $250 million face value. You think, how are you going to do that? I'm going to take a weighted average of the duration of all of your debt, because that's going to give me a duration of the zero coupon bond, and then add up the numbers on all of your debt and make that the face value. It's cheating, but it makes my life a lot simpler. If I can do that, I can essentially value any troubled company. So I'm going to try this on a company called Eurotunnel. Have you heard of Eurotunnel? It's a hole in the ground that connects the UK to France, where cash goes in but never comes out. The reason I say that is originally when the Eurotunnel was built, there were all these dreams about how much money it would make. It has never made money. It's this big money loser. And this was a valuation I did of Eurotunnel in 1998, early 1998. Now remember what characteristics you need to use this option pricing model. First, it's got to be a money losing company. Let's see if Eurotunnel passes that test. In the most recent year, which was 1997, Eurotunnel had operating losses of 56 million pounds and net losses of 685 million pounds. They're money losing. In fact, they've been losing money for a long time. How do I know? Their book value of equity has turned negative. So clearly they're a money losing company. Check. Do they owe a lot of money? God, do they owe a lot of money? I mean, take a look at the debt outstanding. You have short-term debt, 10-year debt, 20-year debt, longer-term debt. In collection, they owe 8.9 billion pounds in debt. And the weighted duration of all of the debt is about 11 years. So they owe a lot of long-term debt. So they're money losing, they owe a lot of long-term debt. So I'm going to try to value Eurotunnel as an option. The first step in doing this is to come up with the S, the value of the underlying assets. So I fell back on what I feel most comfortable doing. I did a discounted cash flow valuation of the company, projected our free cash flows, assumed the margins to improve over time. I did my best. I bent over backwards. And in my DCF value, the value that I got for the operating assets was about 2.3 billion pounds. We're in trouble. You see why? To go back to the previous page, how much money do they owe? They owe 8.9 billion pounds. And based even on what I think is a kind of a coming back to health DCF, the value that I get for the company is 2.3 billion pounds. If I paused right there and asked you, how much would you pay for equity in this company? Value the assets 2.3 billion, they owe 8.9 billion. What's your reaction? I won't pay for the equity. This is a basket case company. And you're absolutely right. On a going concern basis, on a DCF basis, this company's equity should be worth nothing. And in a DCF, that's exactly what I'd expect you to conclude. But why might you want to buy Eurotunnel? Because the debt is long-term and something good might happen. To capture what could happen, I looked at the variance in value, and here I looked at publicly traded shares in Eurotunnel and bonds. Why? Because it was in a sector where there were no publicly traded companies where I could look up the industry average. The stock price standard deviation was 41%. The bond price standard deviation was 17%. So I looked at traded bonds, traded stock. And then I said, what would the variance in value be if I looked at a portfolio of both stocks and bonds? And this company was 85% debt, 15% equity. The variance I got in firm value based on observed standard deviations was 0.0335. What does that mean? The $2.3 billion firm value could change fairly dramatically over time because there's uncertainty about the value. I'm ready. I have all of my inputs lined up. Let me put the numbers in. The S in the model is the value of the asset today, 2.3 billion pounds. The K in the model is what I'd have to pay if I decide to liquidate the firm, 8.9 billion pounds. If I stop right there, you can see this is a deep out of the money option. S is way below K. I have 11 years or 10.93 years, the weighted duration of the debt to play the game. And during that period, the standard deviation in firm value is 0.0335. Let me not drown you in technicalities. If I plug the numbers in, I come up with D1 and D2 and N of D1 and N of D2. What's the probability, Sebastian, that Eurotunnel will not make it?
93%.
93%. I'm walking into the open eyes. I'm saying this company is a disaster. There's a 93% chance it will not make it. And here's the magic. In spite of this dark story I'm telling, the value of the call is 122 million pounds. Why am I paying the 122 million? Definitely not for the dividends. There are no dividends. Definitely not for the cash flows unless I like large negative cash flows. I am buying shares in this company for the same reasons you buy deep out of the money options. I'm hoping that something good will happen. I'm praying that something good will happen. Most of the time, nothing good will happen. But if it does happen, I get a huge payoff. Have you heard of this concept of vulture investing? You know what vulture investors do? They don't buy nice, healthy companies. They buy troubled companies. They buy equity in troubled companies. They buy debt in troubled companies. Let's say you decide to become a vulture investor. You're not buying shares for cash flows anymore. You're buying shares for their optionality. So help me out in terms of where you're going to go look for your bargains. Are you going to look at companies with a lot of debt outstanding or very little debt outstanding? I mean, remember, you make money in the optionality. Nick, a lot of debt or very little debt?
A lot of debt, because that means
Absolutely.
the leverage is higher. So you
want long-term debt or short-term debt?
Long-term debt.
Long-term debt because you need more time on your option.
Exactly.
You want to target risky businesses or safe businesses?
Risky businesses.
This is exactly the opposite of everything you're taught to do, right? I want you to buy money-losing companies with a lot of debt and risky business. You're saying, what? If you're buying options, that's exactly where you should go looking. Who wants to buy troubled, stable companies? I don't even know what that means. If you're buying troubled companies that are underwater, the only chance you're ever getting above water is there's a lot of uncertainty about the future. You're buying options. And that's, I think, the insight you need to bring in mind. Last March of 2020, in my view, almost every airline in the world was trading as an option. Why? Because if you think about it, March of 2020, every airline technically was bankrupt. They owed huge amounts of money. All of their aircraft had been grounded. And I remember people saying, why aren't airlines trading for nothing? I said, because you're getting options. And guess what? Those people who bought those options are really happy today because those options have tripled in value as the economy has come back. There's no guarantee the COVID could have continued for another 3 years and these airlines could actually have gone bankrupt. But getting that insight as to when you have an option is, I think, the key part of real options. I don't care if you ever applied Black-Scholes. It's nice to be able to do it. But if you can understand when there's an option in an investment and you factor that in, that's game one. That's the biggest part of what I want you to take out of real options. So here's the bottom line. There are options everywhere. Most of them you can ignore because they're not worth money. There's no exclusivity. And when they do have exclusivity, some of them can be valued using option pricing models. But even if you cannot value them using option pricing models, just recognizing their options, their option to expand, option to delay, will make you a better investor. So knowing in Facebook that in addition to cash flows, you're getting a platform with optionality can make you a much better investor. So I know we're getting towards the end of the session. I'm going to set up what's coming on Monday, because on Monday, we're going to talk about acquisitions. If you want to know what I think about acquisitions, take a look at my cover page for acquisitions. It's actually, the history of this section of the notes is about 10 years ago. A student of mine who runs seminars in New York City was running a seminar for CFOs of serial acquirers. So these are companies that do acquisition. It's like a book of the month club. They do an acquisition of the month. So CFOs were gathering together in New York. This guy was running a seminar for them. And he said, would you be willing to come in and talk to them? And I said, are you sure you got the right guy? Because you know what I think about acquisitions? I think that they're the mother lode of value destruction, that the most destructive thing companies can do. He said, I know, but I want you to come in and talk to them because for the rest of the day, they're going to be hearing from M&A bankers. You know what M&A bankers think about acquisitions, right? It's the mother's milk of all deal making. They think every acquisition is wonderful. He said, I'd like you to be a counterweight to those bankers. And I said, okay. So I showed up. I remember it was 4:30 in the afternoon. They'd been listening to banker, JP Morgan, Goldman Sachs, banker. 4:30, I showed up and I pulled up my slides and I kind of gave away where I was coming from because the title kind of gave it away. The title for my session was Acquirers Anonymous, 7 Steps to Sobriety. And I picked that title intentionally because I think acquisitions are an addiction. And what I mean by that is when companies start to grow through acquisitions, it becomes very difficult for them to go back to growing the old-fashioned way. You know what the old-fashioned way is? You take project after project after project and you build up growth. It's so much work. It takes so much time. Think of how much quicker it is to go do a $10 billion acquisition. And like all addictions, 2 things happen. It is going to destroy you in the long term. And 2, there are people who feed that addiction. You know the equivalent of drug dealers in this acquisition processes? Who are the people who feed the addiction? They're bankers, they're consultants. They come around and say, just take, this is going to make you feel happy for the rest of your life. Just try this one acquisition. And they know exactly what's going to happen. A year later, you're going to call them in for a second and a third. So I'm going to give you the bad news on acquisitions first as a lead into what we're going to do on Monday. If you think about any acquisition, there are 2 parties involved, right? There's the acquiring company and the target company. If I gave you a choice of which of these 2 companies would you rather be the shareholder in, it's a no contest. If you look at target companies, this is what the red line is, what happens to target company stock price. 0 is the day of the acquisition, big jump in the stock price. Clearly, target company shareholders win in an acquisition. When was the last time you saw about a deal where the acquiring company paid a 20% discount in the value? It's always a 20% premium on the market price. So clearly, it's target company shareholders you win. That's not interesting. Of course, you're going to win. Mechanically, there's no way around it. The more interesting question is, what about the acquiring company shareholders? And there, the answer is not just mixed, it's mixed to negative. Because if you look at acquiring company stockholders, it's a blue line, and you look at them, track them over time, they tend to be losers. So on the acquisition announcement, acquiring company shareholders tend to lose and target company shareholders tend to win. Now, of course, we asked the CEOs of these acquiring companies why this is happening. Their response is, it's because they don't see what we do. They don't see the forecast. We have the synergy, the strategic stuff that we see. Fair enough, it's true. The acquiring company CEOs have access to data that investors might not. But there are studies that look at acquisitions 5 or 10 years after, because the CEOs are right. What should be true? These acquisitions, if they're collectively good, should show up as higher earnings, higher growth rates, higher margins, higher value. And in fact, McKinsey and KPMG have both looked at deals 5, 10 years after they're done to ask this question: are these deals creating value or destroying value for the company? And McKinsey has done these about a dozen times over the last 40 years. And every single time they do it, they conclude that deals collectively destroy value, not add value. This is the same McKinsey that in the same magazine will tell you how great M&A is for companies. So they'll have these articles on M&A is great. Oh, by the way, the data doesn't back it up, but ignore the data. The M&A can be great if you use us. That's very convenient. Collectively, it doesn't make sense. But if you use McKinsey, then the deal is going to be a good deal. KPMG did a study of, I think, almost 5,000 deals in the late 90s, and it asks a very simple and straightforward question. You know that S word that gets used in every deal, synergy? They ask the question, what percentage of deals do you actually see synergy? What do you mean see synergy? Synergy has to show up as higher margins. I mean, that's basically where synergy has to show up. And they found that in 83% of acquisitions, there was no synergy. 1 in 6 mergers created synergy. Much promise, never delivered. And here's the most damning data item to keep in mind. Half of all deals get reversed within 10 years of being done. Now the acquiring company says, guys, we screwed up. AT&T buys NCR. 5 years later, AT&T sells NCR. It didn't work out. So that's a reality. If you look at deals, clearly deals don't create value, at least in the aggregate or on average, for acquiring company shareholders. And if you think this is just a US problem, you're wrong. This is a global phenomenon. In fact, until about 25 years ago, emerging market companies were usually the targets, developed market companies were the acquiring companies. So US companies bought Indian companies. The tide has turned on that. The last 20 years, emerging market companies have become acquirers. I mean, taking the example of India, Tata Steel bought Cora Steel, Tata Motors bought Jaguar Land Rover. So basically, you can take Indian companies and they've started to become the acquirers. And for many Indians, this was a moment of pride. We're now the acquirers. We're the hunters and the US companies are the prey. But you know what? Indian companies are making the same mistakes that US companies are making. They tend to overpay on acquisitions. It takes a longer time for it to manifest. This is actually a graph of what the stock price of Indian acquirers do. It looks good around, but by the time you get to 12, 13, 14 months and reality strikes, people say, well, you paid too much. So here's the bottom line. Firms that grow through acquisitions are more likely to destroy value than to add value. And it's been known for a long time that they paid too much, that synergy doesn't show up. So I can show you 40 years of research. But here's the most troubling thing. While this research has come about, nothing seems to change. Companies continue to do acquisitions, acting as if the data is not even there. There's no learning built into the process. It's not like we're getting better at M&A over time because we have the data. You know what I see in that? There's something that's wrong with the process. There's something systematically wrong with the M&A process that's leading to bad decisions getting. This can't be chance. It can't be one company doing stupid things. There's something systematically wrong, and we know exactly what it is. And it goes back to what we talked about in the first class. I'm an acquiring company. I want to do a deal. I'll do an acquire target company. Who do I approach in the US today? Who's my intermediary? It's a bank, an investment bank. The investment bank is going to be the deal maker. But then I also ask the investment banker to be the deal analyst. You see the internal conflict of interest I've created here? Remember, I asked, said asking a banker whether a deal makes sense is kind of absurd. Of course, the deal's going to make sense. We have a fundamental problem in M&A in much of the world. Deal makers are also the deal landers, and you can't have that. There's an easy fix for that, right? What do companies need to do when they want to do acquisitions? They can hire a banker to do the deal, but they have to hire a third party, somebody else, whose job it is to tell them whether the deal makes sense. Whether it's Duff and Phelps, or whether it's McKinsey, or whether it's somebody else, you can't have the deal maker be the deal landers. But the amount of resistance in this process to that very simple proposition is this insane? Which suggests to me that CFOs really don't want to do good deals. They want to do deals because it's not their money anyway. What do they care if they overpay? Until we fix that problem, and this is a corporate governance problem, bad deals are going to continue. In fact, in this particular seminar, I offered a deal to every single CFO in the audience. None of them took me up. I said, look, I'm going to ask you 7 questions about the basic process of valuing a target company. And I made a deal. I said, if you get more than 4 of the 7 questions right, keep doing deals. But if you fail on more than 3, I want you to stop doing deals. I'm going to show you the 7 questions next class. In fact, I'm going to send it to you ahead of the class. Now I want you to take it. It'll take you only 5 minutes to do. Go through the questions because you already have the foundations to answer those questions right. And then we're going to talk about what bankers actually do in deals. And you can see very quickly why so many deals go bad. So I will see you on Monday. No.
Bye, Professor. Thank you.
Take care.
Thanks, Professor.
Bye-bye.
Thank you. Thanks. So have a good one.
Professor, I have a
Jacob,
question.
your question?
Hi, yeah, I just wanted to know, in the past, like what was kind of the benchmark for getting an A in this class? I know it's based on the Stern curve, so it's not necessarily like a 90 flat.
I think 92.5 is I think the pretty much where the A line. 90 will get you to an A minus usually. So 92.5 I think was the A. So I'll have to let the numbers play out, but no, I would say if you've got 90, 92.5, you're safe. If you have 91, you depend on what the rest of the class does in the final.
Okay, so it falls pretty evenly along, like what is
usually you don't get much variation across time. I mean, the fact that the quizzes have been multiple choice might alter the mix a little bit, but usually those cutoffs are pretty stable.
And can you give me an idea as to like what the outcomes of the quiz are? Because we haven't gotten any statistics feedback on NYU classes.
I'll send you a cumulative effect. So before you walk into the final, you'll have at least a sense of where the rest of the class falls.
Okay, thank you, Professor.
Yeah.
Professor, could I ask you a couple, it's not related to what we've learned the last couple lectures, but in another class, the professor was talking about adjusting beta for cash. And I was just wondering what the logic is when we do that.
What does he mean when he says adjusting beta for cash? Because we did adjust beta. So what was to tell me what happens to your beta when you adjust for cash? Does it go up or go down?
It goes down.
Okay.
We
because
like
you have cash.
Right.
But if you use that beta, in a cost of equity, that cost of equity doesn't work with the cost of capital calculation. And here's why. The cost of capital is your discount rate and your operating assets. Think of what we do in a DCF, right? We value the operating assets using the cost of capital. And then we bring cash in at the end of the game as a separate asset. And because we do that, the beta we should use in a cost of capital calculation should always be a pure beta based on the businesses you're in. The only place where you lose a cash adjusted beta for your cost of equity is using a dividend discount model. But in a dividend discount model, you look at dividends from all of your assets. So technically you can adjust betas, but you got to be very careful. You cannot use a cash adjusted beta in a cost of capital calculation in a DCF because then you'll be double counting. See why you'll be double counting? You push the beta down because you have cash, and then you proceed to add the cash balance. So that's, I think, the tiebreaker. Look at what you're doing with cash. If you're bringing it in explicitly as an add-on, you shouldn't be adjusting your discount rate for cash. If you're not, then you should be adjusting the beta for cash.
Got it. And the second thing was, so with the sales to capital ratio, when we're estimating reinvestment, so like like I was valuing Target, and in their disclosure, management says we're going to invest $4 billion in capex next year. But in my model, I predicted that the revenue would contract slightly next year because this, like the previous year, they had all these, they grew 20% and all that. So I was just wondering how I reconciled those two things.
You don't have to, right? The 4 billion, I mean, companies don't, the way you're doing it in the model is you're having reinvestment. Let's get past year 2021. The reinvestment 2022, 2023, 2024, you're smoothing out the reinvestment. Companies don't reinvest smoothly. If Target invests 4 billion in a year, they don't invest for the next 3 years. So basically, a big investment year is not so big investment. What are they planning to invest the 4 billion in?
It's a lot of store improvements. So they're doing digital fulfillment, so they have to remodel.
So basically, I mean, so what they're doing is they're crumpling up what you've spread out over 3 or 4 years into a single year. Which from a valuation perspective doesn't really matter, right? Because if you took your reinvestment in years 2, 3, and 4, sum them up and show them in year 2, and at 0, 0 in year 3 and 4, your overall value as a company is not going to change that much. Your cash flows are moved across time. So I wouldn't know, if you try to reconcile each year's reinvestment with the actual capex in that year, it's going to be hopelessly crazy because in a year that you do an acquisition, for instance, you have a huge capex and then you take 5 years off. And since we cannot predict usually when the capex is going to happen, and even Target, when they say they're going to spend 4 billion, does that mean they're actually going to spend the money, or they're going to announce the spending of 4 billion spread out over time? You know, so I think trying to estimate when an actual capex happens is difficult. So we smooth things out.
Got it. And it doesn't matter, like the because of the sales to cap, like it would be 0 my capex if they're contracting the next year. Does that underestimate?
No, basically, because all you're doing is getting people to come back into the stores. Let's face it, for Boeing, you can get a 50% growth over the next 10 years and have no reinvestment. Why? Because a 50% growth takes them back to 2019 numbers.
Okay.
All they need to do is get back the 737 MAX drop and the 2020 drop over the next, and that doesn't require more reinvestment. So that sales to capital ratio also is a function for retail, and I'll close with this. There are 2 ways you can grow. One is same store sales, and the other is opening new stores. Same store sales, you're going to give the company a much higher sales to capital ratio. It's a much less capital intensive way to grow. New stores, you have to have a much lower sales to capital ratio. You have to reinvest more. So when you're looking at a Target, not only should you be looking at that 4 billion, but what it tells you about the future plans for Target. Are they going to kind of stop opening new stores or reduce the numbers? Which I think is very much part of their plan. Is they don't want, I mean, this is not a business you win by continuing to open new stores with new lease commitments. So my guess is if you read below the text, you're basically getting a sense of where they're going to grow and how it will play out as sales to capital ratios in the future.
Got it. Got it.
Okay.
Thank you.
You're welcome. Go ahead.
Professor, I just had a quick question on the pricing portion of the project.
Sure.
I'm doing Disney, and I was wondering whether or not it would make sense if, for instance, I did a weighted average across the company's different business segments to get.
You do a pricing of each segment. It's tougher,
exactly.
Right? Because you got to find publicly traded theme parks for the theme park business, publicly traded broadcasting companies. But in principle, at least, it will give you a more precise pricing for Disney. So think of how we did it for United Technologies, right? We broke it into 6 businesses. We did a pricing of each one. You do something similar for Disney then.
Okay. So would it make sense to pull out just 4 or 5 really close comps for each business segment? Or
And you're going to have a tough time getting to 4 or 5 in some of those businesses, like theme parks, for instance. No, you might find it. That's the challenge you're going to face. Is some of those businesses you'll have a tough time finding any companies, but if you can, 4 to 5 would be fine.
Yeah, I mean, for the theme park business segment, I think. I mean, it's a bit. I mean, I was gonna
Six Flags and Cedar.
Yeah, and SeaWorld, but I was also kind of looking at Royal Caribbean as well as Norwegian cruises because of Disney cruises as well. And I was wondering whether or not that would make sense.
No, don't bring in the cruise line companies. They're a complete mess. So I would just stick with the theme park companies then.
Okay, got it.
You might try bringing in European theme park companies. There aren't enough US theme park companies, but there are quite a few in Europe. Lego, for instance, is publicly traded. It's a European company. So you might be able to get to 7 or 8 if you do that.
Okay, got it. Thank you very much, Professor.
You're welcome. Take care.